Hey guys, welcome to the channel. I'm Sheen, your host. This is Money Matters. In this channel, we talk about money, finance, how to grow your money, how to invest your money, how to make money work hard for you. Guys, consider subscribing if you haven't yet already. Give me a thumbs up, really helps out the channel. Check my links in the description below for free stocks with Webull. Sign up for Webull, sign up for Robinhood, sign up for any of those links in the description below. You'll get free money, free stocks, whatever it is. Always good to have free things. So let's get started today. We're going to talk all about stock warrants. So a lot of people have questions about warrants. What are warrants exactly? How do you exercise warrants? Is it better to buy warrants, better to buy the shares, etc., etc.? Make sure you stay tuned to the end. I'm going to go through examples about why usually it's better to buy warrants. So make sure to stay to the end. I explain all that, but just to give you an overview kind of about what warrants are, how much it is to exercise, etc. We're going to give some examples on SEC filings on a few of these SPACs. So first of all, warrants typically are exercised at $11.50. So you see this is for Hyliion, HYLN. You'll see one share of common stock at an exercise price of $11.50. And that is true for the majority of SPACs out there. The exercise price for the warrants is $11.50. But that's not all SPACs. It just depends on what company, whatever they negotiate at. For example, Pershing Square, PSTH, their warrants is an exercise price of $23. So most of them are $11.50, but it's not always. There's no hard set rule on that. Also, most of them is one warrant is equal to one common share, but that's not always true. For example, VLDR, the warrants was one warrant, each exercisable for 3/4 of one common share. So you just have to look at the SEC filings and see exactly how much one warrant is. So why are warrants typically cheaper? Warrants can go from like $2, $3 when the stock is usually up to $10. So why are warrants cheaper? So one of the reasons is there is more risk in a warrant. So if a company does not merge, if the merger doesn't happen, if something falls through, if the current shareholders of that company downvoted and they don't want the merger to come through, if you bought warrants and the whole thing falls apart, the merger doesn't go through, something happens, you lose 100% of your money. If you bought 100 shares, 100 warrants at $10,000, $5,000, doesn't matter, whatever it is, and everything falls through, you lose 100% of your money. That is not true if you bought the shares. If you bought the shares, all that money goes into a trust, and that is held in a trust until after the merger. So if the merger does not fall through, the money in the trust gets refunded back to the creditors, to us. Up to $10. So if you paid $11 for the share and it fell through, you would lose $1 because you would get $10 back. So that's why it's good to get in at the lowest price as possible. So if you bought it at $20 and it falls through, you would lose $10 because you'll get $10 back, but you pay $20. So that's why there is a level of safety on the shares, because you can always get up to $10 back. But with the warrants, you get zero back. So that's why there's more risk in a warrant, and that's why it trades cheaper. Also, there's an exercise price for the warrant. So that exercise price, again, is typically $11.50. So the warrant price should typically always be whatever the share price is minus $11.50. That is what the warrant price is. One more thing is warrants, they have an expiration date. So typically when you buy the warrant, so for example, this is on Fidelity, when you look up a warrant, so this is PSTH, Pershing Square, it tells you the warrant expiration date is July 24th, 2025. So they have time limits. So anytime before July 24th, 2025, if you have this warrant, you could exercise the warrant. You could after the merger, it's typically 30 days after the merger, you can exercise the warrant. You could sell the warrant, you could buy warrants. So anytime before those warrant expiration date, you could trade, you could do anything you want with warrants, but they have expiration. So after the expiration date, then the warrants become worthless. So there is a time expiration for warrants, but there is not for common shares. If you buy common shares, you could hold on to them for 50 years and trade whatever you want to do with them. But so there, like I said, there is a time limit on warrants. So let's take a look at an example. So this is IPOB, which is Social Capital. They are merging with Open Door. I have a video about Open Door, a few videos, so check those out if you haven't yet already. So for instance, IPOB, the stock price is currently $24.08, but the warrant is $6.58. So let's look at the price there. $6.58, I have it written on the right there. So $6.58, you'll have to plus add $11.50 because that is the exercise price if you were to exercise the warrant. So if these warrants were exercisable right now, today, you would pay $11.50 to exercise them. So the stock price would equal $18.08. So you see there is a discrepancy because the stock price is actually $24.08. So it's actually cheaper to buy the warrant in this scenario because you're paying $18.08 for the stock that is actually worth $24.08. So that typically happens before the merger happens because again there's a level of risk if you buy the warrants because the whole thing could fall through and you would lose the price of the warrant. So typically it is a little bit cheaper to buy the warrant even with the exercise price of $11.50. So that's how you kind of gauge how much cheaper it is to buy the warrant. Now if you feel like 100% that this thing is going to go through, or if it's just like literally within a few days that this merger is going to go through and there's like very little risk that the merger is not going to go through and the warrants are cheaper, then it's always better to buy the warrants because you could pay the $11.50 to exercise and it'll still be cheaper than buying the actual common stock. All right, guys, so I'm going to take you onto my screen and we're going to work out 3 different scenarios why it's typically better to buy warrants versus buying actual common stock. All right, guys, so I'm going to demonstrate as best as I can 3 scenarios why warrants are typically better than buying the common shares. All right, so first of all, here is the first scenario. So let's say you had $1,000. So with this $1,000 for IPOB in our example, current IPOB share price is what was it? It was like $24.08, and the warrants were about $6.58. So for those prices, you could get roughly 152 warrants at $6.58, or you could get 41.5 shares at $24.08. So that's roughly what you could get for $1,000. So if that's all you had to spend, which one is a better option? Would you rather get 152 warrants at $6.58 or 41.5 shares at $24.08? And I'm going to share 3 scenarios why usually it's better to get the warrants. This is not always. There's no certainty. This, after all, is the stock market. So anything can happen. Weird things happen sometimes. It just doesn't happen this way. But if all the mathematically, it always mathematically works out that the warrants are typically better. But again, that's mathematically, that's a science. When you're in the stock market, you're dealing with people that do irrational things, buy irrational things, that don't think about it. But the only way we can invest is just looking at the numbers, looking at the math. So I'm going to show you mathematically why most of the times it's usually better to buy the warrants. So here is what the first scenario, and it's probably the easiest one. Let's say the stock price goes up 10%. So for the stock price to go up 10%, it would have to move $2.40. And so the final price would be $26.48. So that's a 10% movement. If it's a 10% movement on the warrants, however, it would only have to go 66 cents. And then it will give you a final price of $7.24. So it is a lot easier to move 66 cents than it is to move $2.40. So price movements of 66 cents could happen, throughout the day. Price movements of $2.40 is more difficult to move. I mean, that's just human nature. 66 cents, people are willing to pay 66 cents more easily than they are willing to pay $2.40. So just general price movement is easier when the number is lower, right? When the number is lower, $6.58. It's easier to move 10%, 20%, 50% when the numbers are smaller because the movement is just smaller. So that's one of the reasons why warrants typically move faster and are gain more in a short amount of time, because again, the numbers are easier to move when the numbers are smaller. So that's the first point why typically warrants are better than the actual shares. All right, guys, so scenario number two, let's say we sell the warrant. So this is scenario number two. Common shares, if you just had the common shares, or you wanted to sell the warrant. So basically you sell the warrant, you don't exercise. Don't exercise it, you just sell the warrant. Okay, so same scenario, you have $1,000 and you were able to get 152. Sorry, let me fix that. 152 warrants at, what was it, $6.58, or you had 41.5 shares at $24.08. Okay, so let's say the price of this stock went up. Let's say it went from $24.08, it went up to $30. So that would mean you would have $1,245. So you would have gained $245. So original, you bought $1,000 worth. The price went from $24.08 to $30, and you would have a gain of $245. So your total would be $1,245 if you just bought the shares. Now let's see if you had the warrants and you just sold the warrants, but you didn't exercise. Okay, so the warrants should be, so if the price moved from $30, moved from $24.08 to $30, that would mean the warrant price moved from $6.58 to $18.50. Now you guys are going to ask, why would it go to $18.50? So the reason is, so mathematically, this is how it's supposed to work out. Keep in mind, this is the stock market. People do crazy things. People are irrational. Weird things happen. But mathematically, this is how it's supposed to work. So the stock price would be $30, and you would have to subtract whatever the exercise price is for the warrants. In this case, it's $11.50. That is how you get $18.50. So I understand, like I said, this doesn't happen all the time because, again, people do crazy things. People could, buy up more warrants and cause the warrant price to go higher, or not buy the warrants and sell a lot of the warrants, and the warrant price will go lower. But if all things equal and mathematically it works out, keep in mind, typically when a stock has been trading for a few months and things stabilize, this typically does work out. This scenario right here does work out. Because just mathematically and price movements, after a certain amount of trading, after the merger happens, the stock has been trading a while, this typically does work out, just because otherwise there will be a huge price discrepancy. And these price discrepancies typically work themselves out as the stock keeps on trading. So, like I said, after a few months of normal trading, this scenario does actually work out. Before a merger, weird, crazy things could happen. Right after the merger, weird, crazy things could happen. But after a few months of normal trading, like I said, this does work out. Okay, so mathematically, this is the best we can do. So if it is $18.50, you have 152 shares. So 1 times 152, that will give you $2,812. So again, if you only had the shares, you would only be up to $1,245 for your initial $1,000 investment. But if you invested in the warrants, $1,000 in the warrants, you would have $2,812. So in this scenario, it's still better to buy the warrants.
Hey guys, I'm recording this after the fact, and I realized that initially I made a little mistake about calculating this last scenario, so I am re-recording this. So you'll notice that the microphone probably sounds a little bit different. I apologize for that. I don't have my normal microphone right now with me. But so this last example, we're going to exercise the warrant, and we're going to work it out and see what happens. So you have your initial $1,000, and you could have bought 152 warrants at $6.58, or you could have bought 41.5 shares at $24.08. So in this scenario, we're going to exercise the warrant. So in order to exercise the warrant, you have to pay $11.50 50 cents per warrant. So times 152. So you're going to have to pay a total of $1,748 in order to exercise. So keep that in mind. So after you exercise, you're now going to have 152 of the common shares, and the price is at $30 because we're saying it went up to $30. So your total would be $4,560 now. But remember, you have to subtract $1,748 in order to do that. So the final gain is actually going to be the same as if you didn't exercise it. You'll be having a net of $2,812. So in this case, if you exercised or you didn't exercise, it would be the same. However, it is still much better than buying the common shares because the common shares, again, if it went up to $30 from $24.08 up to $30, your realized gain would only be $1,245, and that's total. So that's the difference there. So of the actual gain, only $245 if you bought the actual shares, because you have to subtract out the $1,000 for your initial investment. So your only actual gain is $245 here. Hope that makes sense, guys. Thanks very much.
Guys, I hope you enjoyed my video. Hope you found some value. Hope you learned something. If you did, consider subscribing. Give me a thumbs up. Really helps out the channel. Consider subscribing for my membership or my Patreon. It really supports the channel. It really helps me out. And I really appreciate you guys. Thank you guys so much for watching my video. Thank you guys for finding value in my content. Catch you in the next one. Have an awesome day. Peace.